All right, this is March 22 market update. It took me a little time to get this one done because I ran into some technical issues concerning the sector for a few companies. And so I did make those corrections. I don't think it has changed too much about what's going on. But for instance, Walgreens definitely had to be changed to the health sector, which is where it's supposed to be. So anyway, let's go through the uh, February performance, see where everything is, and kind of where we are going. So right away, we're looking at basic materials. Looks like they are performing underperforming rather the market this past month. Just under 4%, but outperforming by quite a bit most recently. And so, again, it just means that before basic materials was much higher than what it is now, but more recently it has come roaring back. And I think that says a lot about, when the economy is doing well, we're building, we're expecting these materials to be used for building and for asset production and things like that. And then we see now that obviously the economy has faltered some, but then again, you have this inflation, right, which causes prices to increase. And so typically that also increases the prices for commodities such as gold and silver and copper and things of that nature. And so I think that's why we see this big rise in this particular sector. So basic materials is a decent sector to be in, and I think it does say something about the economy as well overall. All right, and then I'm curious to see if this is the best performing sector. That'll be really interesting to look at. All right, so communications, again, underperforming the market, slightly outperforming the sector itself. Uh, Consumer cyclicals, again, underperforming the market, and I think that's going to be the case um, for all of these sectors. I think just because the market has been down this past month, slightly outperforming the market. Defensive, consumer defensive is actually doing better than it did before, and slightly outperforming the rest of the market. So that's interesting. And again, I think that says a lot about again where the economy has been, where it's going, and also the inflation, because consumer defensive companies are those companies that you cannot do without. So I don't care what inflation is; these companies are definitely going to be able to raise their prices, keep up with inflation without any problems. All right, energy. This has been a story really all year, actually, and as we see. 100%, 100% of the companies in the energy sector are above their 200-day and 94% above their 50-day. So obviously, the energy sector is booming right now. It's making all the money. It's got to be the best performing sector, hands down. All right, and financials. Again, I think this says a lot about um, where we see inflation going because remember, financials do well when interest rates rise. Typically, inflation causes interest rates to rise, but it's also a political thing, right? The Federal Reserve, the government has to be the one to raise those rates. And we have not seen rates rise yet, and we're in the first quarter of the year. And so last year, we thought rates were going to rise at least four times in 2022. That hasn't happened yet. And I think we're seeing the results of that happening right now in this sector. This is probably the worst performing sector this past month, with underperforming the market by almost 50%. All right, the health sector. I don't know what to say about this. Overperforming the market historically, 80% of the health sector companies are above their 200-day moving average. I think this says a lot. I'm sure, again, this has a lot to do with COVID and the money being made around the COVID pills and whatnot. But they are slightly underperforming the market more recently. So I think that just is showing that we're starting to see a drop off in the fervor around the healthcare companies and the COVID pills and so forth. Industrials. Okay, so again, underperforming long term, outperforming short term. And sort of like the basic materials, again, these are the companies that typically, when the economy is doing well, uh, industrial companies basically provide services and products to businesses. And so when the economy is doing well, we typically see the industrials do well. When the economy falters, then we see them kind of drop off. But the same is also said for industrial companies when it comes to inflation. Many of these companies, like I said, and again, remember, we're talking about the largest corporations here based in the United States. And so, with war and all these things going on, these companies are going to be able to raise their prices pretty much whenever they want to. And so I think that's why we see a more short-term outperforming of the market, even though it's slight. Okay, real estate. Real estate is second to worst performing sector. Again, I think this says a lot about where the economy is. Again, only less than half of the companies are above their 200-day, and even less than that above their 50 days. So real estate is doing horrible. Again, this says a lot about not only where the economy is, but I think also too the expectations on interest rate rise, right? Because if we assume the interest rates will rise, that means the borrowing costs for these real estate companies are also going to increase, meaning it's going to be a lot harder for these companies to make money because basically all a real estate company does is borrow money to purchase property to then rent out or sell, right? And so if you have an economy that's not doing so well, meaning that they won't be able to sell or rent at higher prices, but they're also having to pay more money for their debt, that's a big problem. And I think we're seeing that here in this sector. All right, technology, same thing. This talks about the economy. Technology is definitely necessary, but I think that us humans will put more emphasis on food and housing than we will technology. And what I mean by that is, if the budget starts to tighten up, if you have less money in your pocket, you're more likely to spend less on technology, even though technology is something that is almost a necessity in today's world. And we see, underperforming the market both ways. I mean, half of them are underneath their 200-day moving average. And so the story around technology was about supply chains and this sort of thing. And now I don't think that's the case. Now I think it really is saying that, hey, I don't think things are looking so great right now for the American consumer. And that's why we see the technology sector faltering as we see here. All right, utilities. 70% of the utility companies are above their 50-day. I think, again, this goes back to the consumer defensive plays where these are companies that, I don't care who you are. If you're in America, you're going to have a light bill. You're going to have a heating bill. You're going to have a gas bill. It's just, that's just the way it is. Now these are government regulated companies, meaning that they can't charge whatever they want to charge, but they are pretty good at being able to raise their prices when necessary. And it's going to be really hard for the government to say, well, we know your prices are increasing. We know inflation is out there, but we're not going to let you raise your prices. Typically not the case, but we do see that they are faltering a bit over this last month, but still, it seems to be a decent sector to be a part of. So let's take a look now individually at these sectors. We'll go back up to the top here. So basic materials, we're currently in Southern Copper, which is second in sector NVP. um, but nowhere near sector leading um, in returns. Now, we do have a sell signal on Southern Copper, so we will look at potentially replacing this company. Looks like CF is the clear winner as far as returns go. And just over the last few months, we see a 19%, 13% return. That is craziness, but not far off from NEM that's doing just as well. And then we see gold here, which is actually doing better than Southern Copper, even though both of these companies are rare metals. So that's I think that's interesting to note. All right, communications, AT&T sector MVP, but by far the worst performing. IPG is one of the companies that I had to make a correction for as far as their sector goes. I don't believe they were part of the communication services sector in the past, but they are now. Okay, and so we see that they are leading the sector in average return. This is a advertising company, what they do, advertisement. So it is somewhat of a communications uh, company, but officially they are communication services. So that's what we're going with, even though they don't do anything with telephones or TV or anything like that. It's just strictly just advertising. So it's kind of hard to compare an advertising company with a telephone company, but it is what it is, right? So RCI is where we are. We also have a sales signal on these guys, long-term holding for. So we'll look at potentially replacing um, this position. Again, looks like IPG is not only uh, you know not a sector leading MVP, but at least they have been a few times in the past year on that best performing portfolio at almost 2% a month. Looks pretty good. All right, consumer cyclical, Best Buy sector leading MVP, but not the best performing. Looks like that goes to GPC, which is the auto parts company, which has been best performing for a long time now. We're currently in IP, which is, you know, definitely one of the worst performing um, companies in the sector. We currently have a buy signal on IP. I did do a valuation, and currently IP is overvalued. So we're looking to exit the position at a loss, but we will do that by selling put options. So the idea is to basically make money on the options while we are at the same time looking to exit the position. Definitely don't want to hold it too long because I think I said it before in the valuation video. If IP goes below $40, I just don't see any stopping it from going down to 30. So again, want to exit the position above 40, but want to try to make some money in the interim as well. All right, consumer defensive, uh, Kimberly Clark, sector leading MVP, even though it's really spread out amongst the sector. Looks like the best performing uh, goes to BG. Don't know a lot about the company at all. And we're currently in Campbell Soup up here. Campbell Soup. Not the leading performer. And we don't have a sell signal for yet, but it's been doing fairly well for us. So we'll continue to hold our position there. All right, energy. Valero, where we are, sector leading MVP. Not the best performer. That goes to EOG. No, I'm sorry. No, actually, there's so many companies in here. IMO. IMO. Yeah, don't know a lot about the company, but we do have a sales signal on Valero. Um, and I also initiated an option to purchase more shares. So, unfortunately, we'll have to wait for that option to expire before we really look at possibly replacing. this position. But Valero's has done well for us so far. So we'll kind of stay there, but definitely want to look into IMO, which I believe is like the Canadian ExxonMobil. I may be wrong about that, but all right, financial services. Blackstone, sector leading MVP, has performed really well over the years. Really like the company. Have had a lot of fun following them, and they have just really uh, blown all these guys in the sector out of the water. We are currently in Regions Financial, which has fallen quite a bit, but we continue to hold the position and we'll actually look at, I'll do another valuation on it, hopefully before the end of the month here. But yeah, definitely best leading performer, followed by APO. Well, yeah, almost. Yeah, I think 2% looks like it's sector average. So yeah, BMO, which is Canadian Bank. The rest of these guys, a lot of these guys are insurance companies. Again, typically JP Morgan down here, horrible performer. Citibank, horrible performer. Um, the Canadian banks tend to perform better than American banks for whatever reason. And then a lot of these other guys you see here are actually insurance companies, and insurance companies like Allstate, MetLife, these guys tend to do very well when we see rates rise because again, all their business is getting people to put money into the account, and then they use that money to make money. So when rates rise, typically it means that the fixed rate on investments also rises. There's a lot of these insurance companies, that's all they're doing is investing in fixed rate securities, meaning that they're not putting money into necessarily the stock market, but they're putting money into like treasuries and bonds and things of the nature that have a set fixed um, return rate on it, right? And so as interest rates rise, those return rates on those fixed income investments rise as well. And so insurance companies typically do better. But again, we've seen across the board in the sector, especially if you look over here at this March 22, no, that's healthcare. Go up. There we go. Look at this, just a bunch of negatives. I mean, and that's because we haven't seen rates rise. We all thought rates were going to rise, and it just has not happened. And so I think that once we see rates rise, then we'll see the financial sector rise as a whole. Unfortunately, I think that the Fed is going to look at the fact that, again, I think the economy is not doing as well as they want it to, and they're afraid that by raising rates is going to hurt people even more. And so I think they're going to keep rates lower longer, which unfortunately is not going to fix inflation, but being that things aren't growing very rapidly right now, I don't think it's going to um, hurt much at all either. So we could see low rates for quite a while until something triggers some sort of growth in our economy. Maybe that's the war. Who knows? We'll see what happens here. All right. All right. Healthcare. All right. Merck, sector leading MVP is where we are. Cardinal Health second, and then the rest of these guys are kind of spread out. Walgreens, I think I discussed, is one of those companies that got reclassified to the healthcare sector. Leading performer, though, CVS, which has been the case for a couple years now. They kind of just took off during COVID as one of those, what do you call it? I forget the technical term for it. It's a business that can't close, right? And I think they've kind of just maintained that leadership position ever since. And then Pfizer, of course, the clear winner in the COVID race, uh, comes in second place to CVS. All right, industrials. We're currently in Raytheon, which is the sector leading performer, and I think that is really as of recently because of the impending war. Uh, these guys make missiles and jets and all this kind of stuff. The only thing that concerns me is, I'm pretty sure they've done business in the past with Russia. I'm like 99% sure they've done business in the past with Russia. And so with all these companies pulling out of Russia and pulling support from Russia and with, you know, conversations about what do you call it, sanctions against Russia, Raytheon may not be able to fulfill any outstanding contracts they have with Russia, so that can really hurt um, next quarter's earnings. But we'll have to just wait and see. I did look to see if there was any news at all from Raytheon concerning this, and I didn't see anything. But either way, like I said, sector leading return, paychecks second place, and Fastenal sector leading MVP. We do have a sales signal on Raytheon, so we'll look at potentially replacing this with either Fastenal uh, or maybe paychecks. And I really like paychecks. I really do. Great company. Been following them for a long time. All right. Real estate. MPW is where we are. Sector leading MVP by far. Um, Definitely not the best performing though out of the sector. I think that goes to CPT, which I don't know a lot about. Um, but yeah, just kind of blowing everyone else out the water. IRM, Iron Mountain, I think it's another company that got reclassified into the real estate sector, um, which really astounded me because I've always known IRM to be this paper company that dealt with like office documents and whatever. But they're classified as real estate because most of what they do is storing company documents. So go figure. Anyway, so we don't have a sales signal or anything like that on MPW, so we'll just kind of hang on there. All right, technology. All right, Intel sector leading MVP, but not anywhere near um, the best performer. Matter of fact, I think they're the worst performer in the sector. Yeah, worst performer in the sector. So staying far, far away from there. We're currently in Corning, which has done fairly well for us. More recently, it has dropped in price a bit, but not far enough to warrant any purchases or anything like that. Looks like best performing is Hewlett Packard, which we exited to get into Corning. All right, utility sector. We're currently in ETR sector leading MVP. We do also have a small position in Excel Energy, just down here towards the bottom. Excel Energy, uh-oh, XCL, where we at? See, this scares me. I don't see XCL in here. I gotta go and fix that. All right, so anyway, Excel Energy, we do have a small position there. We don't quite have a sales signal, but it is very close to a sales signal, much like we saw a couple months ago and wasn't able to exit. So definitely going to look at getting out of that position to make some profit. Looks like the best performing is Cheniere CMP. Yep, CMP. Don't have a buy or sell signal on ETR yet, so we'll kind of stay there. But looking just at the individual performance, you can see over the past month, a lot of these companies have fallen, along with the rest of the market. Take a quick look now at an overview. We see so from October, 61% was the no, 82% was the high as far as companies over their 200-day moving average. And then for the 50-day, it looks like 77%. So the same month of February, and that has dropped off to 65 to 46. But it's important to note that that is nowhere near the bottom. So even though the market has fallen, I think there are a few sectors that we've seen that have really increased in performance to keep us from bouncing against that um, December low of 45 and 13. So we're really, as far as the overall market is concerned, we're really still around the top. We definitely fallen off some according to the 50-day, but the 200-day, we're still at the top. So until we see the 200-day drop around this, 40, 50% range, um, we can't really say that we're heading down any sort of uh, bear road, right? We're still at the top of the market. So when I hear people complain or talk about, oh, this market is just not great right now, I don't understand what they're saying. The high for the Dow was 36. We're currently at 33. That's, you know, less than a 10% move. So um, I think we're still uh, good where we are. All right, let's take a look now at our heat map. And I like this thing because just looking at colors to get an idea of what uh, portfolios have been working the best over the last 12 months. So dark green is really good, dark red is really bad, and then when we see these light colored yellows, that's sort of in the middle. So for instance, this one looks really good to my eye. This is standard deviation, and want to want to see if I can freeze top row here. Here we go. All right. Yeah, this one looks good to me. Standard deviation, which makes a lot of sense. Portfolio is not going to move around a whole lot. So you're not going to have a lot of dark greens, but you're not going to have a lot of dark reds either. All right. These are all the dividend portfolios, which we don't expect to do very well, but we do see that at times having that large dividend really pays off. Right? Equal weights. Ooh, a lot of dark red here. Um, that's not good. These are all the return and beta portfolios. And we see across the board in this 1 month, just all dark green. I don't know what month that is, but like everyone did well then. All right, see. It's still red, 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 kind of lightening up here. Still red. This one doesn't look bad, except for this one red spot here. M score beta. Still dark red, dark red. Yeah, I really like that standard deviation one so far. The rest of these things are just so red. My goodness. I mean, yeah, to my eye, the the standard deviation is the best looking portfolio. The rest of these are like bleeding. This one's not so bad. Beta return alpha, not bad at all. Beta return alpha and mm, beta alpha is not bad. Oh, that's so red. Oh, that's super red. My goodness, these things are bleeding. So now, yeah, so even the standard deviation, looking at it a second time after looking at the rest of the stuff, didn't look all that great. So let me go back. The beta, yeah, beta alpha and yeah, and the beta return alpha. To my eye, look the best. Let's take a look at the numbers and see if that holds up. So again, standard deviation. No, 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 no. Sorry. Goodness. I go back. Look at this again. It was the beta alpha. That's right. Beta alpha and then beta, yeah, and beta return alpha. Okay, beta alpha, beta return alpha. All right. So let's look at these numbers and see if the numbers hold up. All negative, about 13, 13, 13, less, definitely less. Ooh, 25. Wow. See if we can get higher than 25. Let's see, that's 20. We're trying to get higher than 25. 21. You know, I don't know why I don't just do the math on this instead of counting myself. I definitely make sure to do that next month. I'm not gonna stop now. Wow, look at this one. 26, that's 29. So we're gonna get higher than 29. Oh yeah, we do, don't we? 24, that's 30. More than 30 actually. All right. 22, 31. Wow. So these two are, I'm not going to do the math on these, but these are both about 31. All right. Same thing here, 31. Wow. See, and that just goes to show you that, you know, colors can lie. So last 12, well, not last 12 months. This is the last, so this is October to March. So what is that, like 5 months? October, November, November, December, December, January, January, February, February, March. Yeah, 5 months. So the last 5 months, um, the it's like the M score portfolios are performing the best. Let's see if I can quickly. Yeah, this is it right here. Well, actually, the up, down, and then the M score. Yeah, it makes sense. I mean, there's a lot of dark green here, and even though there's this one dark red compared to all the other dark greens, it's done really well. See, but yeah, when you see that, just hard to believe, right? Because you're looking at what, one, two, three, four, five, well, 1, 2, 3, 4, 5 months. So if you take out this negative 5 here, right, then I guess that's what really kind of puts it over. But the rest of these guys are the M scores that did so well. Yeah. So the M score, and then um, I said both of these were, yeah. So the M score portfolio, and then the M score down, and then M score standard deviation too. All right, so let's take a look now at the overall performance and see what we see there. All right, so rolling 12 months, beta alpha is best performing, and we saw that just now. And so, um, what that means to me is that we're definitely moving into uh, the more beta portfolios as far as performance goes, meaning the market is not doing so well. And over the last 3 years, M score is in the top, what, five, six positions? My goodness. Go back and look, rolling 12 months, see who else is here. So beta, standard deviation, up moves, M score again, M score again. Wow. So M score plays a big part in this. And I've said this before because we've seen this before, is that these M score companies are really more of a defensive company, not in the sense of companies that perform well when the market is performing poorly, but these are companies that have a lot of cash and not a lot of debt. And those are safe bets, basically. And so I think that's where we're seeing money move. And so that's going to become really important when we look at potentially replacing some of these companies that we have sales signals on, is what companies have the better M score, because more than likely we'll see those perform best. I think it is something to look at as far as the beta and standard deviation as well, especially because I think right now we are seeing a lot of up and down. More recently, more down than up, though, as far as huge variances in market movements day to day. So again, beta and M score. So let's take a look at what those portfolios look like. Let's go down to M score. Right, I missed it. Let's see. Yeah, it's down here. Some of the other M scores, or maybe not, because M score is a new. Yeah, it's at the back. Be so much easier if I just did control find. Yeah, I think the caffeine in this tea has got me moving so fast that I can't move slow enough to be efficient. All right, here we go. M score. All right, so this looks really good. Regions Financial is where we are. Uh, that's like the top position in their portfolio, followed by Best Buy. Paychecks we talked about. Southern Copper were there. OMC for communication. Philip Morris, loved the cigarette company. Years ago, there was all this talk about the health consequences of cigarette smoke, and there was a huge push to get people to quit smoking. And then there was the question about whether vaping was going to take over for tobacco use and all this sort of thing. And now no one says anything about cigarette smoke. Nothing. Even even with COVID, respiratory disease, no one says anything about smoking. I mean, Philip Morris and those guys are way under the radar, and making huge bucks, obviously. All right, MPW is where we are for real estate, so that looks really good. EOG, I think we talked about them along with IMO for energy, so we're looking to that. Merck is where we are. Hewlett Packard for technology. FE for utilities. All right, so let's take a look at some of these other M-score portfolios. We know that M-score div is not it. This is a more defensive M-score beta. Southern Copper, MPW, Philip Morris again, IPG, consumer cyclical. This bothers me because IPG is supposed to have been reclassified. What is going on here? I mean it's open. Okay, so it's calculating, but it's definitely not open. All right. Well, okay. So now it's reclassified. Um, but that bothers me. So let's go back and look at the results and see if they've made any big changes. Beta alpha standard deviation up score. Nope, M score still there. Okay, let's look long term. Long term, yeah, still a bunch of M score. So nothing has changed much. Let's go back now to where we just at. Ah, portfolios. All right. So M score beta. So basically, what's happening is the program still thinks that IPG is in the fourth place in this particular portfolio, and it just literally just changed um, the, uh, the sector, and then added Best Buy for consumer cyclical. So let's go back and look at the M score portfolio and see what happened there. See if there's any changes. No, everything stayed the same there. So okay, so M score beta. Um, All right, so we see again, all right, CINF for financial, IEP industrial, Best Buy again for consumer cyclical, Hewlett Packard again, BMY, and MMP. So it looks like you can switch out anybody in that energy sector and get a decent return. Let's look at M score standard deviation, which again I think is a decent look when you're talking about market moving a lot. Regions Financial, Paychecks, Best Buy again, Southern Copper, OMC, Philip Morris again, MPW again, EOG, Merck, Hewlett Packard, and then FE again. Um, and so, yeah, I mean, this looks really good to me. I've seen EOG quite a bit. There was another one in there, um, M scored down. We're currently following the down portfolio, and we see down twice in this thing, right? And then even here, kind of further down the list, we see the down portfolio. So let's look at that one. And then more recently, again, we're seeing some beta stuff, up moves, but the down portfolio more recently is not working at all. And so again, this goes to show you that the market has changed. It is definitely rolling over, no question about it, because when we first started back in June and July, the down portfolio was the best performing portfolio. And so now that is no longer the case. Um, let's look at M score down. Let's see what's there. And then we'll look at some of the beta stuff too. See what's there. M score beta return, score return alpha. Score M score down. Standard deviation seems kind of cool. But where is the M score down? Can't believe I missed it. There we go. All right. So again, Regis Financial, again, Best Buy, again, EOG, Fastenal is in there this time, MPW again, Cardinal Health. It really looks like the health stuff can be switched out for anybody at this point. Consumer defensive, we've seen Philip Morris quite a bit. It's first time seeing NWL. Hewlett Packard again, EMN, um, first time. IPG again, and then ETR is where we are for utilities. That seems like that can be switched out quite a bit too, because each portfolio seems to have a different utility company, and all of them seem to be at the bottom. which is another statistic that I think is interesting to look at, um, which is, and so uh, let me explain why I'm saying this. So the way the program works is that it looks at um, the score for this particular portfolio. So let's take the M score. Well, let's just go back to M score down, right? So what it does is it takes the M score of this particular company, right? And then it takes the down score of the particular company. It adds them together and then divides by two. Okay, and that's how you get the M score down score. All right. And then what it does is it tries to formulate a portfolio that gives it the highest M score down score possible. Okay. And then it looks at, okay, well, based on the price of the particular company, how many shares of this company does the portfolio purchase at, given the amount of money that we currently have. Okay. And so that's what this looks like here. Um, Total cash is at $5,804. Now, of course, I've thought about playing around with this number, increasing it to 10,000, 20,000, 30, and just seeing what the difference is. But I think, 6,000 is decent. And so again, what it does is it looks at again how to just get the highest score possible. Now, another thing that we can do here, and I have not done this in quite some time, is that instead of trying to get the highest score, it's been so long since I've done this, um, we can look at trying to just balance this thing out, right? So instead of trying to get the highest score, we can just balance it so that each company represents uh, a proportional share of the portfolio, okay? Let's look what happens if we do that. 70% is the return. I have a feeling. I have a feeling this is not working. Or maybe I need to refresh. It's been a while since I played around with it. 7003. Oh no, no, it's working. So 7003 versus. All right. So there is negligible difference here. Not a lot of difference in whether or not we use the balance that you see here at the bottom versus using like I said, the trying to get the highest score possible. All right, so that's that. Um, is there anything else we need to talk about? I don't think so. I think we're good there. So yeah, so again, the market has definitely turned over. Definitely. Oh, I said I was going to look at some of the beta stuff, right? So let's take a look at some of the beta stuff. It's always interesting to see what companies work best or perform better when the market is not performing great. Always interesting to me um, because it just flies in the face of common sense, right? It's like when the market is down, these companies, for whatever reason, either go up or they just go down less than the rest of the market. So beta alpha was at the top of the list. So this one is different too because again, alpha means that they perform better when the market is up. So kind of half and half type of thing. It's kind of weird, but so NEM, Intel, MPW, FE again, Best Buy again, OKE. We've seen Blackstone, best performing financial company. Paychex again, Merck again. GIS is a different thing, and then TELUS for communication services. So this one is weird because it puts utilities at the very top, which is very common for a beta portfolio because those utility companies, it doesn't really matter what the market is doing. The utility companies are going to make what they're going to make. So let's look at. I don't think any of the pure beta portfolios were at the top of the list for any of these. Yeah, nah. Yeah, it's always beta and something else. Very uncommon for like the beta portfolio to be best performing, just because the market would have to basically go down almost every day. The up moves, I don't think there's really a need to look at that. Beta return alpha, I'm sure it's going to be very similar to the beta alpha portfolio. I am kind of curious about the standard deviation though. Let's see what's there. So that one looked good, color wise, but not necessarily number wise over the last 5 months. But rolling 12 months, done great. So here we go. Wow, haven't seen that one. That's a Canadian bank, so doing really well. TELUS Communications, top of the list in this portfolio. Coca-Cola, FTS, don't know anything about them. IBM for technology, Pfizer for healthcare, of course. E&B Energy, Real Estate NLY, and then Paychecks again for industrials. That's interesting. NEM kind of far down on the list, and then VFC, which we never see anywhere. And so again, these companies are companies that don't move around a lot. Like the price just doesn't change a lot. It doesn't go up a lot, doesn't go down a lot. It stays fairly stable, which is great when you have a market that's moving up and down a lot, right? These companies aren't going to lose you any money. And so yeah, it's just interesting. Like none of these companies, other than like I said, Paychecks, which is really interesting, and NEM, um, are part of any of the other better performing portfolios. So again, we see a market that is obviously turning down. Um, I do still think that there is some optimism out there in the form of rates rising. There's still some optimism out there in the form of some of these military, uh, defensive companies. Energy, of course, is doing well. Utilities are doing well. But real estate, I don't know if real estate is going to um, do well until there's some external event that makes people see the economy as growing, right? Because even when rates do rise, the real estate companies won't do as well. So I think we'll continue to see them drop off. Consumer defensive, again, only because they can continue to raise their prices. But again, I think even the consumer defensive companies outside of maybe Philip Morris will see some problems if we see an economy kind of drop off. All right, so that's March 2022.